The U.S. Securities and Exchange Commission has released new investor guidance focused on one of the most critical issues in cryptocurrency ownership: custody. The bulletin, published through the SEC's official investor education platform, explains how digital assets are stored, how crypto wallets function, and what risks investors face when choosing between self-custody and third-party services. This move reflects the regulator's growing emphasis on education as digital assets become more widely held by retail investors. According to the SEC, cryptocurrency wallets do not store coins directly. Instead, they manage private keys, which act as the only proof of ownership and access to digital assets. The guidance stresses that anyone who controls the private key controls the funds. If those keys or recovery phrases are lost, stolen, or exposed, the assets may be unrecoverable. This risk applies across all wallet types, regardless of platform or technology. The bulletin outlines the differences between hot wallets, which are connected to the internet and offer convenience, and cold wallets, which remain offline and reduce exposure to hacking threats. While offline storage can improve security, the SEC warns that physical loss or poor backup practices can still result in permanent asset loss. The agency makes clear that no custody method is completely risk-free. A major focus of the guidance is the distinction between self-custody and third-party custody. Self-custody gives investors full control but also full responsibility for security. Third-party custodians, including exchanges and service providers, may offer safeguards, but introduce counterparty risks. The SEC highlights concerns such as asset commingling, rehypothecation, and unclear treatment of customer funds if a custodian faces financial distress. Importantly, the SEC notes that this guidance does not create new rules or regulations. Instead, it serves as a practical framework to help investors ask better questions and understand how custody choices affect asset safety. Market analysts view the release as a signal that U.S. regulators are adapting their approach, shifting toward clarity and transparency rather than relying solely on enforcement actions. For crypto investors, the message is clear. Understanding custody is now essential. As digital assets continue moving closer to mainstream finance, informed custody decisions may play a critical role in protecting long-term value and reducing avoidable losses.